Is this a delayed reaction to the Fed decision that we're seeing today?
I don't know. I mean, if you look at how the markets responded immediately following the announcement yesterday, I mean, I would say that financial conditions, which I think is what the Fed cares about, not just the level of stock prices, financial conditions on net probably eased modestly yesterday. I mean, you saw
lower yields, weaker dollar.
Weaker dollar. You had some compression in the corporate bond spread, right? I mean, if you look at the the high yield bond, equity ETF, it picked up. So 3 out of 4 ain't bad. I don't think the Fed was unhappy with the market response. Financial conditions are easing. That's obviously something that's important to them. And my own view is that the dollar is likely to continue to weaken this year, and I think that will, over time, bring the discussion about rate hikes back into the fore. Not yet, but certainly something that the Fed may be thinking about as we get into 2020.
Lori, are you feeling more bullish after the Fed yesterday?
I don't know that the Fed really changed my thinking one way or the other. I think there was a 24-hour period where they were a little bit more dovish than people expected, and so anytime you have a surprise, I think it takes the market a little while to digest that. But we really hadn't been banking on any kind of major tightening on the Fed in the second half of the year. We actually thought that with QT already being signaled as coming to an end, that was really more of the big concern for markets at the beginning of the year. So that's been factoring into our thinking for a while.
Did it surprise you that they took the amount of rate hike projections to 0? It seemed to come as a surprise to the market.
I think what's more important is the way they think about the data. So if you're going to raise your unemployment rate estimate by 20 basis points, if you think longer run unemployment, or NAIRU is a tenth lower than where you had thought it, but previously, if you put that into a standard type of Taylor rule, what economists call, that would give you about 50 basis points of decline in the Fed funds rate. So to me, I think what's important is that the Fed is data dependent. I don't think the way they respond to the data has actually gotten more dovish, so I agree. But it's important, I think, for investors to know that those forecasts can change quickly as well. I mean, a lot of the things that the Fed is looking at right now, in my view, whether it's trade tensions, Brexit, the question you have to ask yourself, are these issues going to be as salient 3 to 4 quarters from now as they are at this very moment? And I would argue probably not. And that's one of the reasons why we're sort of negative on the dollar this year. And I think, again, lower dollar, higher inflation, that brings a discussion of hikes back into the table.